The options chain overview. Here's what we're going to cover. What is an options chain and why we use it? We'll overview key components of an options chain, including various call and put options, strike prices and expiration dates, pricing information, what bid and ask means, liquidity, volume, and open interest. So let's dive in. So what is an options chain? So an options chain is a table displaying the range of available option contracts for a particular security, like a stock. It's a tool that traders and investors use to view and analyze various option details at a glance. Think of an options chain as a menu at a restaurant. Your broker or trading platform gives you this menu so you can see all the available dishes or options along with their ingredients, which are strike prices, expiration dates, and prices or premiums. Just as you choose a meal based on your hunger level and taste preferences, you select options based on your market outlook and risk appetite. The options chain menu. The menu offers two main dishes or item categories. The call options, you can see on the left, and the put options you can see there on the right. Each dish has its own price or premium. It also has its own unique ingredients. The strike price, the expiration date, it's kind of like the freshness. Each dish also has its own popularity in the restaurant, the volume, and the open interest. So let's break down an actual options chain. This is the list of strike prices. It's central in the options chain, and these are the prices at which the option can be exercised. Call and put options. Options chains usually show both call and put options. Call options are on one side, typically on the left, and put options are on the other side, typically on the right. Expiration dates. Each options chain is a specific set of expiration dates. You can see in the upper left corner, and this can range from days to years into the future. And now you have the pricing information. So it includes the current price or premium of each option, along with the other key pricing data like bid price, ask price, and last traded price. Volume and open interest. Now these figures indicate how many contracts have been traded in a day and how many are currently open, respectively. Key concepts. So we're going to talk about the bid-ask spreads. So what is a bid-ask spread? Think of buying or selling options as if you were at an auction. The bid price is the highest price a buyer is willing to pay for a security. The ask price is the lowest price a seller is willing to accept. The bid-ask spread is the difference between these two prices. So here's a put example. This put option with the 190 strike has a bid price of 85 cents. This bid price is the highest price a buyer is willing to pay for a security. The put option with the $190 strike has an ask price of 87 cents. The ask price is the lowest price a seller is willing to accept. There's a small difference between what the buyers are willing to pay and what the sellers are willing to accept. You can see 87 minus 85, it's a 2-cent differential between the bid-ask. And this is known as a narrow bid-ask spread. This indicates high liquidity, or that there is a lot of volume and open interest to buy and sell this particular option. So here's a call example. This call option with a 180 strike has a bid price of $17.10. The bid price is the highest price a buyer is willing to pay for a security, or an option in this case. The call option with the 180 strike has an ask price of $17.35. The ask price is the lowest price a seller is willing to accept. There's a larger difference in this case between what the buyers are willing to pay and what the sellers are willing to accept. You can see 1710 minus 1735. That's a 25-cent differential in the bid-ask spread. This indicates lower liquidity, or that there's less volume and less open interest to buy and sell this particular option. Narrow versus wide spreads. A narrow spread often indicates high liquidity, as there is a small difference between what buyers are willing to pay and what sellers are willing to accept. A wide spread suggests lower liquidity, indicating a larger discrepancy between the buyer's and seller's price expectations. Here are factors influencing the spread. Market volatility. Higher volatility often leads to wider spreads. Trading volume. Higher volumes typically result in narrower spreads. So here's another key concept we're going to get into: moneyness. Simply defined, moneyness in option refers to the position of the underlying asset's current price relative to the option's strike price. So key definitions: you're either going to be in the money, out of the money, or out the money, but this is in the money versus out of the money. So in the money, this term is used when the option has intrinsic value, and we're going to cover intrinsic value later. For a call option, the right to buy, it's in the money if the current market price of the stock is above the strike price. For a put option, the right to sell, it's in the money if the market price is below the strike price. For instance, if you have a call option with a strike price of $45 and the stock price is currently $50, the option is in the money by $5. It's kind of like having a lottery ticket that's already a winner. Out of the money. This is when the option has no intrinsic value. And we'll cover this later also in more detail. For a call option, it's out of the money if the market price of the stock is below the strike price. For a put option, it's out of the money if the market price is above the strike price. For example, if you have a call option with a strike price of $55 and the stock is trading at $50, the option is out of the money by $5. And this is kind of like having a lottery ticket that hasn't paid off yet. Now, again, moneyness, right? Again, you're looking at the price of the stock, comparing it to the strike price. There's many strike prices. So on a call option, if the strike price is under the asset's value, it's in the money. And if the strike price is over the asset price, it's out of the money. Now with the put option, it's the opposite. If the strike price is less than the underlying asset price, it's out of the money. And if the strike price is greater than the underlying asset price, it's in the money. Now, also, any option, doesn't matter whether it's a call or a put, if the strike price is relatively equal to the underlying asset price, it's called at the money. So back to the options chain. In the money, ITM, refers to an option that has intrinsic value. This means the option can be exercised and there's money available. It typically applies to a call option with a strike price lower than the current stock price, or a put option with a strike price higher than the current stock price. At the money describes an option whose strike price is equal to the price of the underlying stock. It doesn't have to be exactly equal to it, but it's really close. So here's an example of the option chain and looking at the out of the money options, the one with the arrow there. And it refers to an option that currently has no intrinsic value and applies to a call option with a strike price higher than the current stock price, or a put option with a strike price lower than the current stock price. And you can see that in the chain. Option chain recap. The menu offers two main dishes, item categories here, call options and put options. Each dish has its own price or premium. It also has its own unique ingredients, its own strike price, its own expiration date. Each dish also has its own popularity in the restaurant. It has its own volume and open interest. So here's what we covered: what an option chain is and why we use it, the key components of an options chain, including various call and put options, strike prices and expiration dates, moneyness on an options chain, pricing information, so what the bid and ask means, and liquidity volume, and open interest. We'll see you in the next lesson. My new book, it's out, called All Market Trading Profits. And for those who don't know me, my name is Carl Dahm, and I'm also known as the Transparent Trader. My marketing guy, he convinced me to write a book that shares my secret trade details with you. It's the same trade I used to make $597,210 in third-party verified profits from 2019 to 2023. I'm not sure how long I'll keep these secrets in my book, so you might want to grab a copy before I change my mind. Don't miss out. In my book, I reveal the unique trade structure I developed, something you won't find anywhere else. The book isn't AI-generated content. It's real organic material. If you're interested in learning the trade that drives over 70% of my net worth, click the link in the description to get the book and see how I achieved my results. The book is $30 on Amazon right now, and I'm offering a downloadable version for only $5. See that link in the description.